if I have Amazon, Apple, whatever, and I'm going to hold them, what is the prescription to recover?
Tom, we actually think that in a high inflation environment, that tech just doesn't do as well. So it's interesting. We've been table pounding on tech throughout the last couple of years, but as we rolled into this year, we didn't say short them. We said basically good and neutral, because as long as the cycle continues to be inflationary, they just struggle a little bit more. And what we actually see, and we've done a whole bunch of quant work around this, is that when inflation is high and stubbornly high, you actually want to be in stuff that's more cyclical, beneficiaries of this. So energy stocks, material stocks, and the like. Not because these are the best stocks forever, but they're the best stocks for the moment.
Will those tech stocks continue to have revenue growth?
Yeah, but if you take a look, like in the last, let's say, the most recent earnings season, tech names, grew about 7%, but those cyclical groups grew something like 30 or 40% because they just did better. They have more operating leverage, more physical infrastructure in the kind of old economy cyclicals, and therefore they have more upside. And if you look at this earnings season, those tech companies were, the mega cap tech companies were pretty lackluster. So it's not just a sentiment issue. They're having a harder time, but also they went into the year very expensive. That run that we were predicting in tech played out beautifully, and sometimes you have to know when it's time to take your foot off the pedal, which is what we did on tech earlier this year.
How do retail earnings fit into your thesis?
Well, Lisa, I think that everybody, starting really last Friday, thought that the worst was behind us. And then with, Walmart and Target news, people felt like they got kicked in the stomach, that maybe the consumer's rolling over and companies are going to have margin problems. And then if you actually look, we had a lot of companies like, TJ Maxx and Home Depot and Lowe's, and they did fine. They had beats in the high single digits. It was really a couple of these prominent names like Home Depot and Lowe's had a harder time. And a lot of those were really what I would call is a mix issue. People were buying groceries, but they didn't want to buy furniture and TV sets. And in many cases, these were really merchandising problems. They were kind of the wrong products as people are rotating towards experiences in restaurants and hotels and getting back out. So I'm not sure that we should be over extrapolating some of the bad news from those retailers. But I will tell you, it surely shook the market in the middle part of this week.
So that's the glass half full view of these retail earnings, that basically it is a mix issue, not a consumer health issue. And some people would agree with you, Jonathan, but doesn't that give you a sense that the Fed is going to raise rates all the more so to try to stave off some of the inflationary pressure because the consumer still has momentum, and that presents a valuation problem for stocks, as we were hearing from Savita Subramanian of Bank of America earlier this morning?
Yeah, I'm not sure that the Fed responds to the retail earnings, but I mean
generally the trend.
But listen, wage inflation is really high. When a year ago, when we had 3% inflation, people were saying it's peaking. There's no way it could get to 4%, and now we're over 8%. So the Fed, I don't want to say they're on autopilot for a little while, but they're going to have to push rates, at least to 3%, which is what the market's discounting. And my view is by the end of next year, we may be closer to 4% on Fed funds if they need to, really.
But hold on a second, Jonathan. In all honesty, then, how can stocks keep rallying? How can you get to near 5,000 by the end of the year on the S&P if you get a 3 or 4% Fed funds rate?
Well, I mean, the most important thing is corporate profits are holding up really well. And so take a look at this earnings season. Revenues are running on the S&P 14% this quarter. Earnings are up 12%. So the margin pressure is tiny. But we had this really weird thing going on with the banks with reserve releases. And if you took that out, the revenues were 15% and the EPS was 20%. So the earnings are super powerful and stocks are cheap at this point.
John, that is the most intelligent thing I've heard this week on equity optimism. That differential equation is linked at the hip with nominal GDP and the decline. Are you suggesting within all the Credit Suisse work that the great miss here is that nominal GDP will sustain longer, which will allow companies to adapt into the gloom Lisa just mentioned.
Tom, I think that is the only story. I mean, my favorite, the one screen that I look at the most on my Bloomberg terminal is ECFC. Where is the consensus view on what the economy is going to do over the next quarter and year and 2 years? And what it tells you is that nominal GDP this year should run at 9%. I mean, normal is 3.5%. For all of those folks who say, oh, we're going into recession, economists all over are basically saying this is a rip-roaring economy.
You know, I'm going to tear up here, John. John Golub has really drunk the Kool-Aid at Credit Suisse, Donaldson, Lufkin, Genret. He's on the edge of Tom Galvin here with a sales-centric view.
I'm going to try and be polite here. ECFC, okay. John, has that ever been a leading indicator for anything?
Well, I mean, you know, Jonathan, you have to use some framework to say directionally, where do we think that the economy is going? So if you're looking at, you know, where inflation is going, you can look at the TIPS market. If you're looking where GDP is, there's no tradable instrument on your Bloomberg. You have no choice but to use either your own house economists, and our economists guys are also pretty bullish, or you could just say, where's the whole gang thinking that the growth is going to be, and that's what you find on the terminal. And not only can you do it, but I can see it by firm. So I can say, what are the biggest shops? What do the people at the Fed think it's going to be? They're all in the same direction, which is the underlying economic growth measured in nominal dollars, that's including inflation, is going to be really strong this year. And here's the most important thing. And really strong next year as well. That's not Golub's view. That's
no, I hear all that. I hear all that. It's just the Fed forecast. John, when did the Fed ever forecast a recession? I mean, it's just not. Well, it's not in their business, is it?
They do it about a year with a year delay. You know, they do it after the fact. But listen, I get that, but you have to use some framework to saying, where do you think the world is going? If you ask me what the most important issue is on inflation and growth, we have an incredibly tight labor market, which is leaving the consumer really confident in their ability to find work. And that leads people to be willing to go out and overextend themselves on credit. And it also means that you have high wage inflation. You add those two things together, it's all about the labor market. And that's my take, independent of what you have on that forecasting screen.